Welcome to the Trading Post. Here on this channel, we'll talk about trading stocks, options, strategies, and much, much more. This post and this channel is really for anybody that is trying to trade, whether you're new and developing a strategy or you're a seasoned trader and you have a strategy and you're always looking to improve. This channel's for you. Today's topic, we believe, is one of the most fundamental topics that every trader and investor should be well versed in, and that's emotion. We want to talk about not being an emotional investor. It's the foundation to building a long term strategy that is successful, and it'll save you a lot of headache, confusion, and stress. So, we'll talk about the I feel trade philosophy. You might have heard it and you might have used it. It sounds something like this. I feel like the market's going to go up. I feel like the market is going to go down. I feel like this stock is going to go up, and so on and so on. We want to avoid that trade philosophy because it might just be a phrase and there is research to back it up. But a lot of times when you have a feeling, it's not based off of the tools and resources you're using, whether it's technical analysis, fundamental analysis, charting, or whatever. It's usually just, I looked at it and I have a gut feeling. Most of the time, those trades won't do well. Instead, if you have a gut feeling, back it up with research. We're not saying don't do the trade, but find some research, find something, whether it's in the chart, whether it's in the analytics, that support your gut feeling. Then it's not a I feel just because, it's I feel like this stock is going to go up because it just broke through its ceiling, it's trending up, it has strong numbers, or vice versa. Now, a lot of the times we hear about people trading on events such as earnings, economic reports, the Federal Reserve, or even the election and the presidential debates or the vice presidential debates. If it doesn't work out in your favor, if you feel like the market's going to move one way and it doesn't, you need to take your ego out of it and sell your losers before they do too much damage to your portfolio and your returns. So that's where we're going to focus on today, what it means to sell your losers. Now, before you get into any position, you should have an exit strategy, both on the positive side and the negative side. So if you get into a stock and you think it's going to go up 10%, what do you do when it goes up 10%? Do you sell all of it and look for another investment? Do you sell half of it? Do you sell 10% of it? You need to have that strategy before you even get in. And the most important thing is, what if you're wrong? We all like the upside, and it's important to capture those upside gains. But what if there is no upside and instead the stock goes down? The stock goes down 10%, 20%. Where do you cut the line? So many times we see people that trade, and when it goes down, they just don't want to sell it because they hate selling at a loss. Well, this leads me to number three, where you lose twice when you don't sell your positions when it's appropriate. And we'll talk about that in a moment. We see this most often with stock traders versus option traders. Stock traders will want to wait for the stock to come back. Option traders, because it's short term, that premium, that time value is going to decay. So it's a lot easier to get out of a strategy if it doesn't make you money in the time frame that you thought it would. Now, if the position moves against you, does that mean you automatically sell? No, absolutely not. Let me say that again. If the position moves against you, if you're wrong, you do not automatically let go of the position. Instead, you reevaluate what you see, what you're doing, and where you think the stock is going to go. Now, if the stock goes down, does it make sense to continue to hold? Is it a temporary drop because of news that has less to do with the stock, but more to do with maybe Washington, the stimulus package, coronavirus, or did um, did the company not make its quota or lose a contract? So we want to reevaluate. Does it make sense to hold? Does it make sense to buy more if it's just a temporary drop because of a tweet from our president or, something that came out in the news, and all of the reasons you saw the stock going up are still there? Does it make sense to buy more now it's cheaper? You're getting it at a bargain, so it may make sense to do that. Or maybe you were just plain out wrong, and what you expected to happen didn't happen. Does it make sense to just sell? And again, you lose twice when you don't sell when it's appropriate. And what I mean by that is, if the stock continues to fall, especially with option traders, you're going to see the deterioration of the premium, and you're going to lose more money. But the money that you would have saved if you would have sold could have went into another investment that could have made you money. That's the opportunity cost. That's what we call it. The opportunity cost of staying in, the opportunity cost of being stubborn. So don't be stubborn. Take your emotion out of it and just let go of the stock. With that said, let's jump into our TD Ameritrade platform, Thinkorswim, so that we can see this in action. Now, we believe that from the presidential debate, we thought the market may drop um, after the vice presidential debate. So we took, you know, $400 and invested it in a few puts that would hopefully make us money. Unfortunately, that was not the case. Unfortunately, we ended up losing. Now, you'll see we only have one, if you see down here, we only have one left, and that's okay. When we look at the chart, so this morning we got up, we said, hey, what is going on? And does it make sense to still hold this position? What the vice presidential debate happened, instead of the market going down, the market shot up. So it did not make sense for us to hold the position any longer. We sold at about a 50% loss. So we lost about $200. Actually, a little bit more because we held on to one position just in case. And now we're looking for other investments. Just because you don't just because you trade doesn't mean you always have to trade. And let me say that again. Just because you're trading doesn't mean you always have to find a trade. Sometimes there are going to be times where it's the smartest decision not to do anything. If you don't see an opportunity in the market, don't try to force it. Instead, just let it be, because every day the market gives us another opportunity to make money, but we have to take our emotion out of it. So we were wrong. We haven't placed another trade today. We sold 3 out of the 4 contracts, held on to one just in case. We can make some of that premium back. And we're going to look at tomorrow to see how we do. If there's an opportunity to trade, whether it's the market or an individual stock. With that said, we hope you got a lot from this video. Again, remember to be an unemotional trader, an unemotional investor. That's going to be the foundation to any successful strategy. Avoid the I feels. If you find yourself saying I feel, then follow it up with why. If you can answer the why, then it's just a phrase you're using, versus if you can't justify why that trade is good outside of I have a gut feeling, it might not be the best trade for you. There will be times that your gut feeling is right and it shoots up. There will be times where your gut feeling is wrong and it drops. And by taking that extra step to do that research, you will save yourself money in the long term. Again, we hope you like this video. Comment below if you have questions, reach out to us, and don't forget to hit that subscribe button. Take care.